Peter, you recently issued your third quarter trading statement for the period up to the end of October. How would you summarise the main highlights of that?
Well, there's probably four key points that we made in that statement. Firstly, we've kept our cautious approach to lending. We've had a real focus on collections and arrears management, and that's meant we've been able to deliver good credit quality in both our businesses. Secondly, that good credit quality in the home credit business means that we're well positioned as we move into the peak trading period in the run-up to Christmas. Thirdly, Vanquis Bank, our credit card business, has continued to make strong growth and strong margins. And finally, we've been able to activate retail deposit taking in Vanquis, and that's now live.
You say that your home credit business is continuing to trade well and that credit quality remains good. Given all the economic uncertainty, how have you managed to achieve this?
Well, I agree, the home credit business certainly hasn't been done any favours by economic conditions. But really we've achieved the results through that cautious approach to lending. But in particular, we've done two more things in the last year or so. Firstly, we've tightened underwriting on new customers. So there's now a greater proportion of the credit going to existing good quality customers where we've got a bit more capacity to serve them as there's slightly fewer new customers coming into the business, and that's quite deliberate on our part. Secondly, we've also made some changes in the field to the way we're managing arrears and collections on early stage arrears customers, and those are benefiting our impairment performance.
There's clearly a very significant squeeze on household incomes going on at the moment, and yet you say this hasn't affected your customers' ability to repay their loans. So how does that work?
Well, the first point to make is that our customers' incomes have risen year on year. There's about 3% more money coming into the households that we lend to than there was a year ago. But clearly inflation has been an issue for most of our customers. Food prices have been rising now for a few years, along with fuel and energy bills. So it's fair to say our customers are seeing some pressure on their disposable incomes, although none of that's new or unexpected, to be honest. The other thing is our customers are used to managing on a tight budget. What tends to happen is it tempers the demand for credit and makes customers and agents a little bit more cautious than they would be in better times. But all our experience of operating in this market for a long time says inflation is much more a dampener on growth than it is a driver of impairments in the business.
Your experience sounds quite different from many other lenders at the current time. Why is that?
Well, that's because we are different, and the key point is our loan book has a much shorter duration than most other lenders, typically less than a year. That means that we can adapt our lending policy to factor in things that we can foresee, such as inflation, into our lending decisions. What tends to cause impairments is actually unexpected events, such as redundancy or significant reductions in working hours. Things that can be foreseen, like inflation, can be accommodated and budgeted for by our customers and our agents.
Despite the difficult environment, you still managed to grow your loan book by 3.7% year on year. What is the appeal of home credit to your customers?
We've got about 1.8 million home credit customers. I'm very proud of the fact that we've got just about the highest customer satisfaction levels in the UK of any financial institution. In fact, our last customer survey said 91% of customers were satisfied with the service they received from us. They like the personal approach from the agent. They also like the weekly discipline that the agent's visit provides. The other thing is our products are very transparent, they're very simple, and in particular there are no hidden fees or charges, so customers always know where they are with us. The amount they owe on a home credit loan can never go up, and they like that comfort.
As well as your customers, you refer to the fact your agents are also showing a degree of caution at the current time. Can you explain why this is?
Well, the important point to bear in mind here is that we pay our agents commission based on what they collect, not on what they lend. So there's no incentive for an agent to make a loan to a customer that they can't afford to repay. This acts as a check on impairments, but it also makes sense for our customers too. Now, although our credit policy is set centrally, each of our loans is underwritten face-to-face in the customer's home by one of our agents. Now, they've been doing the job typically for 7 or 8 years, so they know and understand their customers' circumstances really well. Agents typically live in the communities where the customers are, so that means they have really good local knowledge, for example, about what's going on in the local employment market. We can almost run our lending decisions in real time in the home credit business, and that means we can operate in a way that most other lending businesses can't.
So how do you see the near-term outlook for home credit, and particularly the seasonally important Christmas period?
Well, we are about to enter the peak trading period, and the good news is that the home credit loan book is in very good shape. Now, we do expect customers and agents to remain cautious for the foreseeable future, so it's likely that the rate of growth we've seen so far this year will probably moderate a little bit.
Peter, turning to Vanquis Bank, your credit card business, it appears to be performing extremely well with improving credit quality at a time when most other credit card operators are finding life very tough indeed. What are you doing differently?
Well, Vanquis is a bit different because it operates in the non-standard part of the market, and that means we've tailored our products, our customer service and all the credit science that we use in that business to the particular segment that we serve. Now, one of the key parts about Vanquis is what we call a low and grow strategy to credit. So new customers in Vanquis typically join us with a credit limit of £250, so a lot lower than most mainstream card issuers will give. We then take time to get to know a new customer before we'll consider them for a credit line increase. The average balance on a Vanquis credit card account is about £650 today with a credit limit of around £900. So again, a lot lower than most mainstream card issuers would see. The other thing about Vanquis is we have a much higher level of customer contact than most of the credit card issuers would have. For instance, we talk to every customer on the phone at the point of applying as part of the account opening process. We also text message our customers, for instance, when a payment's due or if they've gone over their credit limit.
And who would be a typical Vanquis customer?
A typical Vanquis customer will be in regular employment, probably earning up to £30,000 per annum. They'll have a bank account, but probably only limited access to credit. And they're much more likely to be in rented accommodation than to be a homeowner. Now, obviously, we do operate in the non-standard part of the market. So the other thing you'll see is a Vanquis customer who may well have had a problem with credit in the past, or it may just be they've got what we call a thin credit history, and that could be because they've moved house frequently or they've had very little experience of using credit before. Now, what Vanquis offers is the chance for those customers to build or repair their credit rating.
So Vanquis is operating in a growth market then?
Well, yes, it is. There's probably well over 10 million adults in the UK who can't access credit from mainstream lenders or high street banks. And Vanquis will provide a credit card offer for a good proportion of those. At the end of September, in fact, we had 659,000 customers on the books. And that's a 31.5% increase on last year. Now, Vanquis is the most active participant in the non-standard part of the market, so we are seeing very strong demand for our products. Having said that, we're only accepting about 1 in 5 of the applications that we're seeing, so we're very carefully managing the growth in this business. So Vanquis is a growth business, but those rates of growth are very carefully controlled.
You've reported impairment rates running at record low levels in the business, despite the gloomy economic picture. So how have you achieved this?
Well, we've had very tight credit standards in place now for well over 3 years. And when you combine that with our low and grow strategy, it's not just about being tight on initial underwriting, we've been very tight on credit line increases too. I guess if you think about it, as each month goes by, a bigger and bigger and bigger proportion of the receivables have been originated against those tighter credit standards. So that's really benefiting our impairment performance.
And you've also been investing in Vanquis recently to accommodate future growth.
Yes, well, that's in terms of the call centre. Now, as well as the Chatham call centre, we've recently opened a second call centre for Vanquis in Bradford in our new Provident head office building, and that centre is now fully operational. So in due course, that's going to create about 250 new jobs in Bradford, and that means that we've lots of capacity to cope with future growth.
So the future obviously looks pretty bright for Vanquis, despite the gloomy economic environment.
Well, yes, I think it does. Now, I do think we'll see unemployment increase in the future, although if you look at some of the underlying drivers of unemployment, such as youth unemployment, they're not really segments that are going to affect our business. And although Vanquis customers are typically in more regular employment than our home credit customers would be, we do believe the business is less sensitive to changes in the employment market than a mainstream credit card issuer would be. And that's because of our tight underwriting, our policy of only serving customers with limited indebtedness, and the low and grow approach to credit. And all that means that the risks in the business are really well controlled.
Vanquis has recently launched a range of retail deposits for the first time. What's the strategy behind that?
Well, Vanquis has always had a banking licence since it was started up, and it's always been our plan to fund the business with retail deposits when the business got to scale, and we define scale as £300 million of receivables. Now, we passed that milestone during the second half of last year. So following a dialogue with the FSA, I'm really pleased that we've been able to activate deposit taking into Vanquis as a means of funding the business, and we started that in July.
So the early indications from the launch of the retail deposits programme are pretty positive by the sounds of it.
Yes, I'm very pleased with how the launch has gone. We've already raised £50 million in fixed term deposits with a 1 and 2 year duration, interest rates are between 3.2% and 4%, and that's very much in line with what we expected. Now, we quite deliberately had a slow start, but during 1 week in September, when we dialed the rates up to near the top of the best buy tables, we brought in £30 million, so there shouldn't be any worries around bringing in the amount of money that we need to fund Vanquis. So the plan from here on in is to get to a deposit book of between £100 and £125 million by the end of this year, and then by the end of next year to be funding 80% of the Vanquis receivables, which is the target we agreed with the FSA.
So what are the main attractions for Provident Financial of raising retail deposits?
Well, firstly, it allows the Provident Financial Group to extend and diversify its funding base. Secondly, it means that the Vanquis business is now self-financing, so no longer needs funding from Provident, the parent. And thirdly, with the interest rates that we're paying, even after adding the overheads and liquidity requirements, it means that the rate of interest on those funds is quite attractive. It's less than 6%.
So what is the outlook for 2011 for Provident Financial?
Well, firstly, the balance sheet's in great shape, obviously enhanced by the launch of the retail deposits programme in Vanquis. Secondly, credit quality in the home credit business is very sound, and that leaves us well positioned as we go into the peak trading period, notwithstanding the fact that both agents and customers are a little bit more cautious than they were, and we're still trading in line with plan. Thirdly, the quality of the receivables book in Vanquis, the strong margins that we're earning, and the continuing investment in the customer base leaves that business positioned to deliver an excellent result for the year. So overall, we anticipate a good result for Provident Financial Group for 2011.